president of a wholesale provider of business purpose capital says technology and talent will drive success for his company. My name is Kimberly Haas, and I will be the host of this podcast. Ben Fertig at Constructive Capital in Illinois recently sat down with the mortgage note. He said the company grew in each of the last 2 years.
Maybe we could start by having you tell us a little bit about what's happening at Constructive Capital and what you've been seeing in the first half of 2025.
Yeah, sure. We provide capital to third-party origination network, mainly made up of mortgage brokers who, and we provide that capital exclusively for real estate investors. We don't do anything that's consumer related or non-owner occupied. We provide that capital primarily through two asset classes: residential transitional loans, which are your fix and flip loans, your bridge loans, your ground up construction loans, the shorter duration loans in terms of maturity, and also DSCR related products, which are the debt service coverage ratio loans, which are a 30-year product that is designed for a real estate investor who is going to acquire or already owns and then stabilizes with a tenant, rental income, a property that they intend to hold. Our origination population is definitely more heavily concentrated in the DSCR related products. Relative to 2024, we are ahead of pace. We grew 30% in each of the last 2 years on average. We're up year to date about that now through 2 quarters. Margins are not quite what they were. I think they're a little bit tighter. But I think that we've seen, with all of the macroeconomic noise, right, whether it be tariffs, whether it be inflation, whether it be deficits, whether it be all of the geopolitical tension, that we're hearing about, I think the liquidity backdrop has still been healthy, and the end borrower demand has still seemingly been good. So I think we're kind of cautiously optimistic going into the second half of the year that the markets are going to be orderly and conducive to continue to grow responsibly. And I think that's how we feel about it.
How have risk management tools helped to prevent fraud?
So I think if you're familiar with OCR, which effectively will read a document and it'll extract data from documents and put it into different places, like into the loan origination system, for instance, right? It can read a balance off of a bank statement. It could read borrower's name off a bank statement. It could analyze the transaction history to the extent there's large deposits and those types of things. So some of these programs, the one that we use has about 12,000 templates that it understands. Even some of them are non-domestic banks. They're international banks. Kind of gets down to credit unions and remote areas and everything else. So if anything is off in terms of fonts or anything along those lines, it'll detect it. If any of the calculations are off, it'll detect it. It actually will track back the cookies on anything that's been changed relative to a PDF or anything along those lines. So I think that's been a big, that's definitely been a big development. And OCR has been around a long time, but integrated with AI, it's got that detection capability. So the other things that, there's other programs that'll pull in all the pictures historically from a property relative to its MLS listings or anything else, where you can really see whether rehab has been done and track it back sequentially. That's been helpful because the nature of real estate investing is you'll buy something at presumably a discount or a good acquisition point. You'll put in work and then you'll develop this forced appreciation, which, by the way, some of the time is warranted, right? But that does have a tendency to get pushed in transactions, as you can imagine. So the ability to kind of just track the visual nature of that property through a tool is very helpful in our space. There is another tool out there that has aggregate a lot of data in terms of predictive analytics on whether or not a project's likely to get completed, what a certain input of a scope of work is going to result in. So it kind of checks and balances, some of the math being submitted on a proposed project against, available data. That's been helpful. There's been some good advancement on project inspections. The market's gone towards some virtual inspections when it comes to work being done. There's actually tools that can tell, if just from a visual, if a project has got, for instance, like click wood flooring versus real hardwood flooring, it's pretty good stuff. I mean, so I think we've got it all, right? And then you've got to get it into the right spots in your process and put it together comprehensively. But that's been a lot of the focus, and I think that's where the market's going to have to go, because I think that's ultimately going to be what the expectation is in the secondary market, what the expectation is at the rating agency level.
Well, it sounds like you've definitely taken a lot of steps towards making sure that you're as secure as possible. How has things like fraud impacted performance? Has the secondary market reacted in any way?
Great question. Yes, is the answer to that. A couple of things that we're seeing is that, I mean, this is across the industry. You're starting to see, occurrences of misrepresentation in large borrower concentrations. One of the great things about lending to residential real estate investors is that they're a recurring borrower base, right? It's always been super positive in terms of your cost to acquire that customer versus, let's say, a homeowner or consumer, right? Because that borrower is going to borrow either recurringly or they're going to borrow on several properties at the same time in some type of portfolio structure. And when you start cross-referencing that with non-performance, and then I think it has this amplified effect. So you've seen the secondary market start to, suspend purchases in certain geographies where, they believe there's some collusion, right? And they just seem to kind of stepping back from that.
The last time we sat down, we were talking about brokers and your broker base.
Yep.
What advice are you giving those brokers right now?
Yeah, the same advice. You've got to diversify into residential investor loans. I mean, and look, I think it's multifaceted, but number one is the diversification of revenue into rate agnostic, or at least more. I mean, rates matter somewhat, but more rate agnostic asset classes is one. Secondly, the acquisition of the borrower is just more efficient because that borrower should be a recurring borrower, right? Most real estate investors do more than one loan or project. And then I just think if you're somebody who is hiring, like the retention and the recruiting of loan officers, like you've got to have these products, in your arsenal to be able to attract and retain your sales staff, because let's face it, I mean, the large majority of them without a refi market out there, are challenged at this point, right? So I think we're all about diversification at Constructive, and it's not just us. There's other good, market participants in our space. We are set up for somebody who has historically lent to a homeowner, whether that's through conventional loans or FHA or government loans, to, bridge some of the gaps that you have to deal with in an investor loan, lending to an entity, for instance. That's not something that they may do on a regular basis. we all have support networks for that to make that all, just about seamless. But I just can't look. I mean, 2022 was the best year in residential investor loans, right? It came down a little bit in 2023, back up in 2024, and all the year-to-date data would suggest that this is going to be better in 2025. And I think it's a mistake to, not diversify into these products. I know it is because, look, at the end of the day, where rates have been on a nominal level just hasn't impacted, and it's exactly the opposite in the conventional classes, right? And the consumer classes. There's a lot of reasons for that. I mean, there's a lot of value to a real estate investor in an acquisition, for instance, right? And whether that real estate investor, will perfect the financing at some later time, they're still looking to acquire properties, especially in this supply constrained market. Although it's loosening up relative to what it was. Where on the conventional side or the consumer side, like somebody's calling you to refi once every several years when rates go really low, right? So it's a different thought process, it's a different dynamic. So I think they've got to be in these products, and there's a lot of good capital for them to work with. And so we do work with brokers who focus solely on the investor, but we also have some big broker clients who you would know, whose core business, when it's there, would be, would be conventional and govy. But they can do it all, and they need to do it all, and we'll help them do it all. But that would be my advice.
Awesome. Well, thank you so much for your time today, Ben. I really appreciate it.
Thank you for listening to this podcast. Once again, my name is Kimberly Hawes. Have a great day.